Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Wednesday, the 22nd of March, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. So, we will go through our usual regular run through of data, macroeconomic events, what's coming up, what's influencing markets. Take a look at the charts. However, first of all, just to say we have launched our updated website in here today. Look at those good looking chaps. Hey, look at those two. I think the guy on the right's slightly better looking, if I'm honest. So yeah, take a look at the new website. Feedback welcome. More importantly, a new set of and further smaller and bigger programs in here. Smaller and bigger programs in here have been launched, and with slightly different rules. No stop loss rule now, different timelines, different targets, different trading max drawdowns, different position limits, different prices, different tiers of programs. Please do take a look at these. And yeah, I mean, give us some feedback. If you want to switch onto one of these, you'd have to cancel your current membership to go onto one of these programs, or you could let it run to the end of the month, or until you maybe next. If you have to hit reset, maybe you want to switch then. It's up to you. But do let us know. If you're on a current program, you can stay on that program. But obviously at some point we will sunset those programs. But you can't sign up to the old programs now. If you are on the current programs, you can stay on those, or you can switch across to one of these other programs. That is your choice. Please do contact us with any questions, any queries, any feedback, please. On the website or the programs or anything you want. That's done. That's the housekeeping done. It's all about the Fed today. I can't really say much more than that. I'm going to have to keep this webinar relatively short because there's only so much. It's all going to look a lot different in however many hours it is now, between 6.5 hours time. It's all going to look a lot different. Fed at 2:00 this afternoon. Remember, not only do we get the rate change, we get the projections. Going to be super important. The dot plot chart. Remember the dot plot chart? Okay, looks like this. Dot plot, and the last one we had was December. God, how much have things changed since then, right? Dot plot, Fed, December, okay, 2022. That was the last one we had. Where is it? Probably best get it from Bloomberg. There it is. There. That's the most recent one in here. Okay. Back here on Bloomberg. This was back then, back in the day. Here it is here. So that's the last dot plot chart we had. Things have changed a lot since then, right? But we are now looking at potentially, I don't think it's so much on what they do with respect to, this move. Clearly it's important, but it's all going to be about what we have going forward. If you look now, we're kind of nailing on 25. The market's completely gone to 25 after what the ECB, the fact that we've had a calm down. Remember, at one point this was 50-50, beginning of this week, after the banking bond crisis, or mini bond crisis we had in here at the beginning of the week. Then the market has kind of reverted. It's pretty nailed on now. It's all going to be, but the market's now pricing in a rate hike now, a rate hike in May. We go to June, on pause. July, cut of 25. September, maybe staying the same. By November, another cut of 25, back to where we are now. So up and down from now through November, up 25, then kind of on hold. Then up 25, up 25, on hold. Down 25, September or July through November. By December, the market's pretty much pricing in. Actually, this morning, this was higher. So we were pricing in a cut. By the end of the year now, we're looking at unchanged. It's going to be on that guidance. It's going to be on the statement. It's going to be how much of a nod they give to the crisis. It's going to be on the Q&A. Between 2 o'clock, where are we? Sorry. Between 2 o'clock and 2:30, okay, we could see a complete reversal after 2 o'clock through 2:30. Maybe we get some kind of reaction initially. We're going to get those projections and the statement. maybe then when we get the press conference, Powell gives us more detail and it could go the other way. Be careful at the next potential move at 2:30 today. So yeah, all of that in here needs to be watched in here, guys. So yeah, it's going to be interesting to say the least. Okay, so watching out. I mean, I don't have a huge amount to say. Five things to cite today. Clearly, all eyes on the Fed. It's going to be really important. An intervention at First Republic, possibly a government backing. So that's a positive in here, carrying through from yesterday. Since that sell-off we saw, remember, it was all about the AT1 bonds. We spoke about that, those convertible bonds, okay? Since those COCOs, they're called, yeah, we looked at that yesterday. I can reshare that one with you guys for anyone who missed it yesterday. Where are we? AT1, so you can get the same article. Yeah, there it is, there from CNN. It's a good little explainer article. Yeah, so these bonds in here, take a look at that. I've just thrown that into the chat. Okay. These additional tier one bonds, contingent convertibles. Okay. There was the shock from that sent us significantly lower. And we can see it really if I go and take a look at some of the charts in here. If I look at the 10-year note, we had that big sharp push lower in yield. Remember Monday morning, okay, in Asian and European time, even pre-US Open, we were trading below the lowest point on the 10-year yield and 2-year yields across the curve in here of the year. Okay, went to yield lows not seen since, where were we? Over here somewhere, right? So we went to yield lows not seen since September of last year. Okay, and then we got a massive intraday reversal. Let me just get back to where we are. Massive intraday reversal on Monday as the market calmed after that initial panic, and then yesterday a big move to higher yields again. Okay, so the market kind of not as panicky as it was. So we got that. So this big kind of hammer pattern on the yield chart. It's a shooting star pattern, candlestick pattern. Go take a look at the technical Tuesday. Last technical Tuesday I did about key reversal patterns, hammers and shooting stars. And that's certainly what we got back up there on Monday. And if we go and take a look at it on the price chart in here, let me look at that first of all on the price chart for bonds. In here, there's the shooting star, okay, and back lower. On the bond market, there's a 10-year note on the futures. And if we go in here after the daily on the NASDAQ, we saw the sell-off and rebound, okay? So it's not a turning point here, but it rejected. So it's not really a hammer because it's in an uptrend already, but nevertheless rejecting the downside. Same for the S&P, a bit more like a hammer because we're closer to the bottom turning point here. But you certainly got a long-legged doji back at the bottom down there last week. So, and then higher again in here on the S&Ps yesterday, and the market hovering near the highs. My big concern, right? I'm bullish. Okay, I'm bullish on this. I've been bullish since last week. I've been making that clear. I've been bullish in here. I'm bullish now on the longer term as well. I think we're going up here. Okay, my big concern. Okay, and this is you have to just react to what the market gives you, right? And the Fed are going to give us something massive today. I tell you, my big concern is they don't pivot more dovish. Okay, the market here. The curve is pricing in a really dovish Fed, not only through the summer. So we're going 25-25, but they're also pricing in on pulls through the summer, okay, through June, July, and then rate cuts at the end of the year. The Fed may pull the carpet from under us, okay, with respect to rate cuts. They could just rule out rate cuts. They could say we're in no point of thinking about rate cuts now. If there's any kind of language on that, if there's anything in the Q&A, if they don't give a massive nod, if they say, okay, we've got other measures to deal with the crisis. The crisis is not anything like that. Anything that downplays the crisis, keeps the focus squarely. Now, they should have, the right thing to do is keep the focus on inflation, but they have to give a nod to the crisis. They have to give a nod to the fact that this crisis is putting the brakes on not just the US economy, the global economy, okay, the European economy, the Asian economy. It's going to put the brakes on down the line, okay. It's going to erode corporate sentiment. It's going to erode consumer sentiment. Okay, it's going to erode investor sentiment. So all of those things in here are going to put the brakes on, and that is worth a certain amount of rate hikes. Okay, so they have to take that into consideration. And they don't want the market. They obviously don't want the market going into freefall. They don't want to at this point in here give too hawkish a signal, because if they give a hawkish signal, okay, they should be just like the ECB were last week. Okay, the ECB were focused on inflation, kept the focus on inflation. They hiked, and the market survived it. Remember, we were in the middle of the Credit Suisse fallout. It started breaking Tuesday through Wednesday through Thursday, and the ECB still hiked last Friday 50 basis points as they said they would, okay, and as the market expected. Even though the market started shifting a little bit more dovish, the ECB stayed true. Remember in here, going back to the calendar in here, looking ahead now to tomorrow, we get the SMB tomorrow. They're on track. We're expecting them to hike by 50. Look, previous 150. That hasn't changed. The Bank of England, we're expecting to hike 25. Look at this Bank of England data from this morning. Look at the CPI data, massively above expectations. 9.9 on the CPI expected on the year on year, 10.4 it came in. A couple of articles on this. UK inflation surprise pressures Bank of England to raise rates again in here. The pound has gone higher in here. Traders bet on more Bank of England rate hikes after ugly inflation data. So we're nailed on for another 25 from the BOE, the Bank of England tomorrow. Yeah, the central banks have to stay on course, but hopefully down the line they're not going to have to be as aggressive. Okay, but look, the Bank of England are getting backed into a corner. We've got, you've got a mini banking crisis going on, and inflation is ticking back up higher. So there is an issue there certainly for the Bank of England. So the Fed, things are easing a little bit, but equally, I don't think they can. All the articles I've got in here are just on the Fed, right? There's nothing else in here. It's all Fed. On Lagarde this morning, look, Val's robust policy with the ECB ready to act as needed. Underlying inflation shows no evidence of trending down. The ECB are going to stay on course. They're going to keep hiking rates, okay? A robust approach that allows it to respond to inflation risk, but also to give financial aid to markets, right? That's Lagarde this morning. Central bankers seem to be keeping this relatively hawkish tone despite what's been going on. So I think the big risk, I think the market wants a dovish statement. It wants a dovish shift in the dot plot chart. Remember, we've got that dot plot chart coming up. If we don't get it, we could see stocks hit significantly on the downside. So as bullish as the chart's set up for me, and as positive as I am, I still think there's a big risk in there. And I'm more than happy to abandon the bullish view and switch more negative. So don't get tied to any kind of view in here. All right, guys, I haven't got a huge amount to say. We've looked at the CME. Let's just quickly look at the charts in here. But this thing's going to leap. Don't forget, guys, this thing could easily be. S&P could easily have a 3-4% day in either direction, right? Easily 2-3, right? The Nasdaq definitely up to 3-4%. It could easily be a massive move because this is the biggest unknown we're going into. Remember, we've been in blackout. The last time Powell spoke, he was super hawkish to Congress, 2 Tuesdays ago. Since then, since the collapse of SVB, which seems ages ago now, they've been in blackout, okay? We've been, there's been no Fed speak, we've been in blackout? Yeah, blackout period. We've been in blackout period since, where is it, 23rd, since the 10th, right? Or something like that, where is it, March 23, since the 11th, since the Saturday. SVB failed on the Friday, the 10th. Since the 11th, we've been in blackout. So, it's going to be, it's very much a big unknown. Not so much what they're going to do today, right? We can see that, right? Look, nailed on in here, 90%, 25. They're going to deliver 25. The forward guidance, the dot plot chart, the press conference, the statement, all going to be super, super important. And if they don't pivot more dovish, I think we could see stocks get hammered on the downside. My view remains bullish. I'm 55, 60% bullish going into this, but quite happy to flip that view. Okay. So, I don't think there's a huge amount of, we'll go and look at it. I would literally give a nod to the charts, guys. But for me, this is setting up more bullish, but you've got the trend line that comes down through here. This is on the S&P. You're probably watching out for that, right? Can we get above and hold above here? Okay, but it's going to go one way or the other, guys. Right? It's almost like boom, we're right on the trend line. It's about to make a decision. On the intraday chart, we've already looked at previously. You got that inverse head and shoulders down here, came back in a big retest. Now we're back up here. This was on Monday after the panic that we saw Monday in European Asian time, and it's the same thing on the Nasdaq. Nasdaq's already through these trend lines, but look, it's sitting right below that peak there. That peak up there, 99. 12.924 and a quarter, 12.924 and a quarter. Through there in here, it looks a lot more bullish, okay? But again, on the 15-minute chart in here, you've got that inverse. You've got inverse head and shoulders in there, and in that little mini inverse head and shoulders becomes the head for this bigger head and shoulders. We've pretty much already hit the target on that. Remember, the target is that distance there. projected up. We've pretty much hit target on that on the upside, but we're obviously sitting right below that little swing peak there. Through that peak, easily up to the peak, could be pointing to a new high for the year. Could easily hit a new high for the year, the Nasdaq today. Can easily see this up 3%, 4%, maybe even. Yeah, if the Fed do pivot more dovish. The market is setting up very, very bullish, though. I wouldn't be surprised if we've already got the long trade is already quite crowded, I would suggest. But the bigger picture, the long-term money, the real money, okay, pension money, life insurance money, long-term fund money is underweight still. So there's still a lot of long-term money to come to the market, and they could shift and come into the market today. So even though probably the fast money is already long, yeah, hedge funds probably already long. The real money accounts are probably not long, okay, or are still underweight. So we've still got those to return. Okay, guys, I'm going to wrap it up there. I don't, it's going to be wait for the Fed really, see what they say, and give us some feedback on the programs. Give us some feedback. Send us an email, ping us an email, or put it in the forums, whatever you want, guys. Yeah, but take a look at the new tiers. Take a look. Let us know what you think. Let us know what you think about the website if you like it. Yeah, I'll leave it there. We'll be back with you. I'll be back with you with another Bull versus Bear webinar tomorrow. Until then, take care, stay safe, and have a great trading day. Helmets and goggles for the Fed. Cheers, guys.